I hope my screen is visible, uh, everyone. I'm going to resume the June 25 exam. We did question one yesterday, which is the section A question. Now we will be attempting the section B question, which is like uh, question two and question three today. Okay, so I'm going to resume. Resume test. The answer is yes. I don't know why it is taking so much time. Mhm. It worked. Great. So it opened up the last, my force closure of the browser. Um, Section B. Should I start? All right. Farhan, we will be doing two questions today. One will be question two and one will be question three, i.e. the section B of June 25 exam. For sure, Farhan, please do that. I have already uploaded the answers of question one on the drive. So if you want to reconcile your answer, you can access that drive. Okay, let's start today. The section B, we have two questions to do. So I'm a bit cautious of time. You should assume that today's date is 1st March 2025. The finance director of Cloak Limited has requested advice on the corporation tax implications of the following: the sale of warehouse and shares in a subsidiary company, the sale of warehouse and shares in a subsidiary company, commencing trading activities overseas via either a permanent establishment or a subsidiary company. The following exhibit available on the left hand side of the screen provides information relevant to the question. Clock Limited. This information should be used to answer the question requirements within your chosen response options. Okay. Clock Limited. Clock Limited prepare accounts to 31st March each year. Prepare accounts to 31st March each year. Has forecast total taxable profits from its UK operations as follows: 130,000 in the year ending 31st March 2025 before taking account of sale of warehouse and the shares in Set Limited. Okay, so this 130,000 is before taking account. Like these two items are not adjusted in this. 145,000 in the year ending 31st March 2026 before taking account of planned overseas operations. acquired 80% of the ordinary shares in Set Limited on 1st January 2020. Clock Limited and Set Limited are both UK tax resident trading companies. Clock Limited has no other associated companies. You know, till here, reading the question, reading the requirements, the one very important thing which is continuous in my mind is they are in the capital gains group, group losses group. Even if we dispose of the shares of this Set Limited, uh, it would be exempt under the concept of substantial shareholding exemption because both are UK tax resident trading companies and shareholding was like more than 10% in last 12 out of 72 months. I can see. But let's see what is the requirement. Acquisition and sale of warehouse. On 31st March 25, Clock Limited will sell a warehouse to an unconnected person. Warehouse to an unconnected person. Clock Limited acquired this warehouse from Set Limited on 1st April 2024 for its market value on that date. Whatever is the transaction, whatever is the transaction amount, whatever is the transaction price, since this transfer was within the capital gains group, hence it would be at no gain, no loss. Set Limited purchased the newly constructed warehouse from an unconnected person on 1st April 20 and began claiming structure and building allowances immediately. Okay. The information is available in relation to the warehouse. 1st April 20, cost to Set Limited 192, building of which building is 102, land is 90. 1st April 24, market value 234, 148, building market value, land market value 86. Seriously, land market value declined. 31st March 25, sale proceeds 255, of which building 165, land 90,000. Okay. Set Limited and Clock Limited have used the warehouse only in their respective business since 1st April 2020. Rollover relief will not be claimed in respect of the gain arising on this sale. Fine. Acquisition and sale of shares in Set Limited. Clock Limited acquired its shareholding in Set Limited for 440,000 on 1st January 2020. Clock Limited will sell this entire shareholding to an unconnected company for 510,000 on 31st March 2025. Clock Limited trading overseas. On 1st April 25, Clock Limited will commence trading in the country of Hedlia, either through a permanent establishment or by incorporating a wholly owned subsidiary company. The overseas operations will have forecast taxable profits of 30,000 after all relevant deductions for the year ending 31st March 2026. It is expected to remain profitable for the foreseeable future. Okay. Operating in Hedlia through a permanent establishment. This could be Clock Limited, only permanent establishment located in overseas country. Clock Limited will not make an election to exempt the profit of overseas permanent establishment from a UK taxation. Will not make an election, means there will be no election, right? Operating in Hedlia through a wholly owned subsidiary company, which would be incorporated in Headlia, would pay an annual dividend to Clock Limited, would not be a controlled foreign company. Tax system in Headlia. The rate of tax on profits in Headlia is 22%. So if I do have a look at the rate of tax of Headlia, Headlia would not be a controlled foreign company because in UK, the max rate of tax is like 25. If I take the 75% of 25, it is for sure less than 22%. So there is no double tax treaty between UK and Headlia. There is no double tax treaty. No double tax treaty means if double taxation, that will be considered, that will be managed with the help of double tax relief, right? Um, till the scenario, before I start looking to the requirement, before I start writing the answer, any point anyone want to ask, anyone want to clarify? Anas, my prayers are with your comment. Let's look into the requirement. Um, calculate with supporting explanations. Calculate with supporting explanations. The increase in Clock Limited Corporation tax liability for the year ending 31st March 25 as a result of selling the warehouse and shares in Set Limited. B. On the assumption that overseas business is carried on by Clock Limited through a permanent establishment in the country of Headlia, calculate the total tax payable by Clock Limited for the year ending 31st March 26. On the assumption that overseas business is carried on by wholly owned subsidiary of Clock Limited, explain the UK corporation tax implications of this strategy for both Clock and the subsidiaries. Your answer should include an explanation of corporation tax consequences for Clock Limited of the receipt of dividends from the subsidiary company. Guys, to everyone, couple of very important things. First of all, at times students do not give a due care on these verbs. Now, if I ask you, the first verb is the first verb is let me talk about requirement A. Calculate with supporting explanations means if I look into this part, calculation is main. um, so the let's name the requirement first. Increase increase in corporation tax liability. So let me name it in this way. Increase in corporation tax liability. Mm, for the year ending as a result of selling the warehouse and shares in Set Limited. So the question is divided into two parts. One is the sale of warehouse, and second is the uh, sale of shares, right? Sale of warehouse. The sale of warehouse would result in gain of mm, working on sale of warehouse. Sale proceeds, sale proceeds I recorded 255, right? Anything anyone like to comment after this 255? Anyone, please. Anything to include after this sale proceeds? Very good. So it's like add SBA claimed. SBA claimed would be 192,000. Oh, not 192. Sorry. 102,000. March 21, March 22, March 23, March 24, March 21, 22, 23, 24, 25. From a paper perspective, you are not supposed to do what I'm going to do right now. This is basically for copying purpose and your future reference purpose. Cost. Cost would be 192 or 234. Uh, Cost to set will be base cost and SBA need to be added in disposal proceed. Correct, Bakhtavar? So just to confirm from others, cost should be um Aisha, if I ask you the same question, should we consider degrouping chart? And why you think yes? Why you think no? And just to confirm, is it think yes or no, or is it like confirm? Mhm. Uh, Bakhtavar, closer comment, but the exact comment is like the concept of degrouping charge arises when company is leaving the group. So, for example, I am parent, and let's say Aisha, you are subsidiary. I purchased an asset from you, or you purchased an asset from me, either of the way, and either of us is leaving the group. So, at the moment, no one is leaving the group. At the moment, we are disposing of the asset. So, just imagine, um, the easy way to remember the concept of a degrouping charge is from the concept of unrealized profit, which we normally use to study at time of consolidation. Is there any unrealized profit, or the unrealized profit is now under the transaction which we are doing is going to be realized, because unrealized profit remains when the asset is within the group. Under this transaction, the gain which we computed 78,300, um, we are going to have a look at this yellow highlighted warehouse to an unconnected person. So we are selling out this warehouse, this asset to an unconnected person. So whatever was the unrealized profit, now that unrealized profit is going to be realized. Hence, there is no degrouping charge concept. Aisha, does it help? Yeah. So again, this is the point which I was thinking while reading the question. What are you supposed to calculate first? Are you supposed to calculate the gain on shares or the sale of warehouse? What you are supposed to consider first? That's why I'm not considering degrouping. But if it is other way around, like first, let's say I have to consider the disposal of shares, then sale of warehouse, then I would have considered the degrouping charge. Okay. And maybe two, three times, four times, even more than that, I try to pick up the difference in date, like when the warehouse is going to be sold and when the shares are going to be sold. Then I realized that both transactions are happening on the same day, 31st March, this date, and disposal of shares 31st March. And that's why I highlighted this date. It's like both are happening on the same day. Now I was thinking, what is going to happen first? If sale of shares is going to happen first, then yes, there will be a degrouping charge. But if sale of warehouse is going to be happen first, then there will be no degrouping charge. Perfect. Few points to consider in the gains calculation are: one, clock limited and set limited were in chargeable gains group since 1st April 2020, as clock limited owns 75% or above, i.e., 80% of the shares of set limited. Therefore, the disposal of warehouse from set limited to clock limited on 1st April 2024 would be at no gain, no loss for tax purposes, irrespective of consideration paid by clock limited to set limited. For tax purposes, it will be treated as if clock limited had acquired the warehouse on 1st April 2020 for its cost to set limited. Uh, First point clear to everyone? Second, there is no balancing adjustment for SBA purposes in respect of building on which SBA has been claimed. Hence, Block Limited continued to claim SBA on the original qualifying cost of building. However, because Glock Limited received the warehouse in a no gain, no loss transfer from Set Limited, the total allowances under SBA claimed by both companies will be sale of warehouse. Story clear? Great. Great, Aisha. Sale of shares in Set Limited. Any maybe one two words thing which we need to elaborate or discuss about. Anas, great. SSE, we need to talk about SSE. And so we need to talk about SSE in the sale of shares in Set Limited. We need to discuss the conditions, how the conditions are meeting, and the final implications of SSE. Like if the conditions are meeting, exempt. If we conclude conditions are not meeting, then we have to compute the gain. So this is the direction of the answer to this heading. I hope directionally we are clear. Since we already read the scenario, uh, based on your assessment, uh, would we qualify for SSE? Correct. So we will discuss each and every condition of SSE and then we conclude whether it's meeting or not. But apparently, while reading the question, it looks to us that conditions are meeting, right? The gain arising on the sale of clock limited %80 shareholding in will be exempt from corporation tax due to this is because clock limited owns at least 10% of the shares in set limited for a continuous 12-month period and set limited is. So I concluded for the sale of shares. The total increase in clock limited's taxable total profits for the year ending 31st March 2025 would therefore be guys, I'm just taking a minute pause. I'll be back over here. But if I look this particular line, and I request everyone to please have a look at this particular line, do let me know the implication on corporation tax. Do let me know the implication on, again, the requirement is not the implication on taxable profits or total profits or augmented profits. The requirement is the implications for corporation tax. So what will be the implication on corporation tax of these gains? Obviously, corporation tax will increase. By how much will it increase? So on this 130, we concluded like one transaction is exempt, which is the disposal of shares. And on one transaction, we are like, there will be gain. Once gain, obviously, due to gain, obviously, profits will go up, tax will go up. But what is the increase in tax? Can I have please uh, feedback from everyone on this question? I hope you guys are clear what I'm trying to ask. Articulation is secondary, maybe a one-liner answer. That the impact on corporation tax will be by this amount. And Bakhtawar, how you computed this 7077? It looks to me somewhat 10 type of percent of this amount. That is true, Bakhtawar. And then Bakhtawar, you know, to be very honest, you are thinking exactly in the right direction, 100% in the right direction. But I don't know why you are bit off tracking. Bit. Uh, Arib, Mumtaz, Muhammad, Anas, Farhan. No one. Let me have word with you guys before I start writing this. Um, like Bakhtawar said, in this question, Clock Limited has one associate, which is Set Limited, right? So due to the associate, upper limit and lower limit will be reduced. Upper limit would be like 250,000 is the upper limit divided by 2, which is like 125,000 would be the upper limit. Okay. If I look into the profits of Clock Limited, it is already 130,000. It is already 130,000, which means that already the company is paying tax at the main rate, which is like 25%, right? Now, whatever will be additional profits, 78,300, straight away the additional tax on these gains would be 25%. So straight away 78,300 multiplied by 25%, whatever is the answer, would be my impact on tax or increase in corporation tax. Is this explanation clear to everyone? Thanks, Aisha, Muhammad, Anas, Farhan, Arib, Bakhtawar. You are now clear, or still any confusion? You know, I do recall the examiner feedback on this question, and the examiner feedback was majority of the students forgot to consider the associate company and they applied the marginal rate of tax. Recall 26.5, which we calculate at time of losses. So the majority of the students are like it is 130, 130 plus 78, 300. So since we are in the marginal relief type of category, hence they apply 26.5 to calculate. So I'm, oh yeah, exactly. That is, so this is the point, Bhaktar, this is the common feedback from the examiner that students forgot to consider or missed to consider the associate company implication while answering this part of the requirement. Now, we are clear what is the answer. We just need to articulate it properly. For the accounting period ending 31st March 2025, Set Limited is an associated company of Clock Limited. As Clock Limited will have shareholding. Shares calculation. Sorry, Farhan, shares SSE point. I can do that right now. I just need to, let's say, close this. Hope it's visible. Will have shareholding of more than 50% during the accounting period. The upper and lower limit would be prorated by 2. Hence, they would be 125,000 and 25,000 respectively. Clock Limited's taxable total profits prior to making these disposals were forecast to be 130,000, such that it would be it would already be paying corporation tax at main rate. In this paragraph, I established the fact which I discussed with you guys, right? Once fact established, then it's just a matter of single line. Accordingly, as a result of these disposals, there will be an increase in corporation tax by um, 19575. Hmm? Where's my coloring? It is not. It is not the case generally. On the assumption that the overseas business is carried on by Clock Limited through a permanent establishment in the country of Headlia. Calculate by Clock Limited for the year ended. Calculate the total tax payable. There is no explanation to this. Okay.
Hey, Roger, how are you?
The total
Did
tax
you
payable.
enjoy, did you enjoy the food?
I hope you guys were not interested to listen all that, right? The total tax payable by Clock Limited for the year ending 31st March 2026 corporation Trading profit was 145. What was the profits of Headlia overseas permanent establishment? 30,000. Are we supposed to consider marginal relief over here? Because in the year ending 31st March 2026, there was no subsidiary. Since there was no subsidiary, so upper limit would remain 250 and lower limit would remain 50. Since now the profits are in between of upper and lower limit, hence I am like, we will get marginal relief. Marginal relief would be 250,000 minus 175,000 multiply by 3 divided by 200 multiply by Aisha, I hope you can see the working now. I hope it's done. UK tax on double tax relief, double tax relief. Overseas tax 30,000 multiplied by 22%, 6,600. UK tax on overseas income. Four two six two five. Is it clear? 36025. Following the sale of shares in Set Limited on 31st March 2025, Clock Limited will have no associated company in the year ending 31st March 2026, such that the upper limit and lower limit for augmented profits will be Therefore, the main rate of corporation tax would apply along with marginal relief. Sorry, Aisha, sir, can we directly calculate UK tax? So, Aisha, why I calculated in this way? Reason being there was no, like there was marginal relief in it. Otherwise, if let's say corporation tax was 19 or 25, i.e., no implication of marginal relief, then I would have calculated in this way exactly, like directly multiplying by 19 or 25, whatever is the appropriate rate of tax. Uh, Aisha, I hope my explanation is clear. Exactly. So due to marginal relief, I calculated in this way. If there is no marginal relief, let's say directly 25 or directly 19, then I would have directly applied the respective rate of tax. And Aisha, in continuation to your question, this is true across all of the taxes. Like, let's say if a person remains in high rate, previously 40, remains 40, then maybe we really do not consider such type of things. But if rate of tax is changing, if personal allowance is being tapered, then effective rate differs as compared to the normal rate. Just to give you a reference, yesterday we were doing one question. Uh, in the yesterday question, where we have the car benefit, it remains within the high rate. That directly 40% can be used. We not calculated, but I demonstrated, I do recall that we can directly use 40%. But for other part where we have the accommodation benefit, there the personal allowance was being tapered, then effective rate, would it remain 40%? The answer is no, it would differ. Um, Explain the corporation tax implication of this strategy for both clock limited and subsidiary company. Your answer should include explanation of corporation tax consequence for clock limited of the receipt of dividends from the subsidiary company. So this requirement is of 6 marks. So 6 marks means uh, at least three very solid points. Very solid points. Any high level points? High level points. First high level point, subsidiary, increase in associate. All of the profit would be directly taxed at 25% because upper and lower limits will be reduced. The first point. Second point, um, there will be no tax on the dividends received from the company as it is an associate, and from associate we receive dividends and there is no tax on dividends. Second thing. Thirdly, there will be no UK corporation tax on the foreign dividends, on the income earned by the company, right? Any further thing which you can think of? The subsidiary company would be an associate company for Clock Limited. For the purpose of determining the rate of for future accounting period, such that upper limit and lower limit would be 125,000 and 25,000 in future accounting periods. As Clock Limited, taxable total profits are forecasted to be 145,000 for the year ending 31st March 2026. They will exceed the revised upper limit of 125,000 before consideration of such that Clock Limited will so on the in these two paragraphs, I explained the implications for Clock Limited. Now, as the Farhan, yes, the answer is yes. So subsidiary has to pay corporation tax of that particular country. The profits of the overseas business will only be subject to the subsidiary company accordingly. Any dividends received by Clock Limited from the overseas subsidiary will be exempt income for the purpose of UK corporation tax. The dividends will also not be included in calculating augmented profits for Clock Limited because Clock Limited and the overseas subsidiary will be associated companies. Um, I hope this would be like pretty much clear. Unless you still are on your statement, question looks easy. Okay. Anything to ask, anything to clarify before I move on to the next question? Perfect. Sounds good to me. Good to hear this, Aisha. Glad to hear this. And you know, more of clarifying the confusion. What matters means you should be conceptually clear. If you are more conceptually clear on the degrouping charts, I'm like, to be honest, I'm more glad on that. Heading towards the next requirement, the next question. You should assume that today's date is 1st April 25. Adil and Chikta, like, I don't know why names are weird throughout the paper. Adil and Chikta have requested advice in respect of the reduction in their combined income tax liability, following the transfer of an income producing asset, the availability of gift holdover relief on gift of shares, and the consequence of making such claim, the availability of BPR, and the maximum potential inheritance tax liability which may arise on the gift of share. Maximum potential inheritance tax liability, two conditions, maximum and potential. Maximum and potential. Maximum and potential. What does it mean? Maximum and potential. Maximum means uh, maximum and potential. If I look into combine, it looks to me like I have to assume there will be no relief type of thing. No, no, it's not NRB type of thing. So NRB, I would consider the NRB thing, but it's like there will be no other relief type of stuff. Okay. Sorry. Scenario first. Adil and Chikta are not married but have lived together for many years, are both tax resident and domiciled in the UK. Are not married means there will be no inter-spouse exemption or relief type of stuff. Okay. Adil will have total income in the tax year 25-26 as follows: trading income, rental income from a UK investment property, dividends from Bovic Limited, and dividend income from other UK companies. 90,000 total income for Adil. Will either will gift either his UK investment property or entire shareholding in Bovic Limited to Chikta on 6th April 25. Okay. So you know what I'm looking for? I'm looking for either the reduction in income would be by 15,000 or the reduction in income would be by 12,000. Has made one previous lifetime gift to his daughter on 1st July 2022, which result in a gross chargeable transfer of 108,000. Gross chargeable transfer means diminution in estate was 108,000. Chikta will have income from employment of 14,000 for the tax year 25-26, which will be her only source of taxable income in this year. Will retire from this employment on 1st March 26. Will sell the asset received from Adel on 1st March 27 when it is anticipated to have increased in value. Okay. Adel shareholding in Buvik Limited. Adel acquired 10,000 shares, 12% shareholding in Buvik Limited on 1st March 23 for 386,000. The market value of these 10,000 shares on 6th April 25 would be 404,000. Buvik Limited is a tax resident unquoted trading company, owns assets which have a total value of 4.5 million on 6th April 25. These assets comprise trading assets valued at 4.1 million, of which 3.8 million will represent chargeable asset for CGT purpose, and shares in a quoted company valued at zero point 0.4 million held as long-term investment, which is like non-business asset, right? Calculate with supporting explanation which of the two potential gifts from Adil to Chikta will produce the greater annual net income tax saving for the couple. Are they a couple? Seriously. Well, uh, calculate with supporting calculate explanation. So again, calculation is important. Explanation would be in support. On the assumption that Adil gifts his shares in Buvik Limited, explain why gift holdover relief will be available for the purpose of CGT. Why? Why gift holdover relief will be available? Explain the impact of making gift holdover relief on the chargeable gain which will be realized by both Adil and Chikta. On the assumption that Adil dies before 6th April 32, explain the availability of gift of BPR in respect of the gift of his shares in Buvik Limited, and explain the specific circumstance in which the maximum IHT liability would arise in respect of this gift and calculate the amount of this liability. All right. Sorry. I'm making my working simple. Adil is a higher rate taxpayer. Total annual income of 90,000. And SICTA is a basic rate taxpayer. In respect of both gifts, the full amount of the transferred gifts would fall into the higher rate band for Adil and would fall to the basic rate band for SICTA. The income tax saved from gift of UK investment property would be 15,000 multiplied by 40% minus 20%. The income tax saved from gift of UK investment property would be, and tax saved from gift of Uvik limited shares would be dividend high rate of tax minus Can someone please tell me the answer? I can see two comments. Just a sec. Good on us. So I have no issue. Like I can perfectly imagine that you guys understand the investment property thing. Having said that, I want to ask, are you guys clear on the tax safe from the gift of shares? Don't understand the question or you don't understand the requirement, Farhan. So the okay, what I asked. So my my question is my question or the examiner requirement. What you not understand? Oh, so Farhan, just imagine. Let's suppose you have some property and investments. Let's say investment in shares type of stuff. Okay. Imagine you transfer the asset to, let's say, your brother, your sister, your mother, your father, or your children. Let's say, would there be any change or impact in the tax? Yes, no. So, what will be the impact on tax to be precise? Uh, that is basically the ask over here. Exactly. So, just imagine, let's suppose now, here is the deal. If let's suppose both are high rate taxpayer, then maybe there will be no tax saving. The tax saving would reside if one is primarily high rate or additional rate and other one would be in a different tax band, if I would say. The status of the taxpayer is changed. So if I look over here, Adil is basically a high rate taxpayer who has income of somewhat 90,000 per annum. Whereas if I look Sikta, and I hope she won't mind if I look her, she has employment income of 14,000 this year and she will retire from employment next year. So next year, she won't have any income at all. In fact, this year, even this year, she won't have the complete 14,000 of employment income because she will be retiring on 1st March. So if I talk about a specific fiscal year, 25-26, sorry, 26-27. So 25-26, it would be complete 14. From 26-27, it will not be even complete 14,000. So sorry, we solve it in a way before and after. So before and after, again, the calculation would be too long. I am cautious of the marks as well. The marks are 5. If you calculate before and after, I can tell for investment property, answer would remain 3,000. But imagine the level of calculation you need to do. Like currently, you have to calculate the income tax liability of Adel, SICTA at a level of 90 and 14,000. Then you need to recalculate their tax liabilities. uh, if and you know that's why I put a first paragraph. If you look into my first paragraph, if you look into my first paragraph, in the first paragraph, I establish the fact that the complete amount falls in one particular band. So if either we consider for SICTA, either we consider for ADIL, the complete amount remains within the same band. Since no change of band, hence we can directly take 20 or 40 type of percentages. So Farhan, I hope I answered your question. Anas, I will not lie, this question would have troubled. You know, maybe I was making this comment yesterday, Anas, on your point. Like, this is a kind of tax planning type question. If you ask me, is there any difficulty or is there any complexity in this question? I promise no. But like I said yesterday, for a tax planning question, you need to plan the answer how mathematically from every aspect we should pursue this. If you decide this correctly, tax planning question is always easy. But if you're not able to create the structure properly, it will become a nightmare. Aisha Noor, sorry, I missed your comment. Just a sec. Let me have a look on your comment. I understand the question, but I calculate tax here from the whole of incomes like we made whole income tax calculations. Aisha, maybe I answered your point as well. Uh, like we can do in that way. I really don't mind that. But calculations would become, I'm cautious of this as well. Is it really worthwhile doing all that stuff for 5 marks? Yeah. Can I have the answer? Last shares one. No, no one wants to 3044. Thank you, Anas. Maybe a stupid question, but a question. Uh, everyone clear with this working? 15,000 multiplied by 40 minus 20. Everyone. In this overall working, a question. Why I not deducted 500 with this? Why I not deducted 500 with this? Why I not deducted 500 with this? Uh, Farhan, my dear friend, HRTP still gets the dividend exemption. So dividend exemption is not status dependent. I hope you understand my answer. Why not? Anyone? Arif, Aisha, Madeline. Mohammed, and Anas. Very good, Aisha. Exactly. Very good. So this is to be precise the reason. Since he has already other dividends, so none of the 500, like there will be no impact of removing these dividends, whether they remains, not remains, no impact. So that's why. So I'm going to write this line, okay, because this is something which is not explicitly clear. Very good, Aisha. Adil has other dividend income, which will utilize the dividend nil rate band, which will utilize the dividend exemption. So this will not be SICTA has no other dividend income. So the dividend exemption will be available to reduce the amount of the dividend, which is taxable at 8.75%. Therefore, gifting the shares of Vuvek Limited will lead to greater net annual tax savings for the couple of if I ask a simple one word, in your opinion, gift holdover relief, would it be available? Yes, no. Gift holdover relief, would it be available? Okay, I hear you, Aisha. What about others, please? Farhan says yes. Okay, so let's look into this, please. Gift holdover relief is available because Uvik Limited is an unquoted trading company and SICTA, the transferee, is UK resident at the date of gift. 2 marks, 2 points, 2 conditions. That's it. Two. Explain the explain with supporting calculations the impact of making gift holdover relief on the chargeable gains which will be realized by both Adil and Chikta. Impact of gift holdover relief claim for both Adil and Sikta. The gift of shares will give rise to a chargeable gain for Adil of 404 minus 386. The differential is like 18,000. 18,000. Since Bovec Limited have some non-business assets, hence the gift hold over relief will be restricted to the proportion of gain which relates to the chargeable business assets of UVEC Limited. This is calculated by reference to chargeable business assets to chargeable total assets. Chargeable business assets were 3.8 divided by 3.8 plus 0.4. Obviously into 100 for percentage, like that goes without saying. UVEC Limited has 90.48. UVEC Limited has 90.48% of business assets. Hence, gift holdover relief will be one six two eight six. Hence, gift holdover relief will be the chargeable gain of 1714. The deferred gain of 16286 will be deducted from the base cost of the shares for SICTA. Consequently, gain realized by her will be effectively increased by the amount of gift holdover relief. Can I ask a simple question? Would BPR be available? By the way, uh, I hope you guys are clear with part B2. Thanks, Aisha and Nas for the feedback. Noted, Aisha. Anas, your feedback noted. What about others? Others' perspective? Very good, Farhan. This is maybe the comprehensive answer which I was waiting for, like a complete statement, whether it will be available or not available. Thank you, Farhan. So this is what I will be covering over here. But mm, any limitations which any one of you want to uh, talk? No? Okay. I'm going to write the answer. Uh, Again, anything particular? Uh, Anas, you mean holdover relief? Yeah. The gift of the shares will qualify for BPR at the rate of 100% as Uvik Limited is an unquoted trading company and Adil have owned the shares for at least 2 years prior to the date of gift. However, the relief would be restricted to restricted due to the non-business assets in the company. The proportion of relief would be restricted to 4.1, 4.1 plus 0.4, 89.13% calculated as 4.1 divided by 4.1 plus 0.4. Hence, the BPR would be 404,000 multiplied by 89.13%. 404,000 is the diminution in state amount, right? 360, 360087. It is also necessary that SICTA owns the shares at the date of Adil's death or if not, she invested the proceeds in qualifying business property. ACCA will sell the shares on 1st March 2027. Further information is therefore required as to whether or not a qualifying replacement asset is acquired or not. Maximum potential liability to IHT. Maximum potential IHT liability. Guys, maximum potential IHT liability. Maximum potential. So maximum potential IHT liability. So if I look into the requirement, explain the specific circumstances. So first I need to explain the specific circumstances. So it's not like directly start writing the maximum IHT liability. First, you are supposed to explain the specific circumstances in which the maximum IHT liability would arise in respect of this gift. So first, explain the circumstances in which the maximum IHT liability would arise and calculate the amount of liability. So calculation is towards the end. First, you need to explain the circumstances. I hope the requirement is clear. The maximum IHT will arise if adult dies one after 1st March 2027 as BPR will no longer be available on the assumption that SICTA does not acquire replacement asset. Second, prior to 1st July 2029, as he has made one gift on 1st July 2022, which will use part of his nil rate band if he dies prior to this date. Second, third, before 6th April 2028, 3 years after the date of gift on 6th April 2025, as taper relief will be available after this date. Annual exemptions are available for the tax years 25-26 and 2024-25, such that the gross chargeable value of the gift will be IHT liability. The maximum potential IHT liability is therefore 398,000 minus 325,000 minus 108,000 multiplied by 40% 325,000 minus 108,000. 398,000 minus 72,400. So I can tell the IHT liability can be less than 72,400, but it cannot be more than 72,400 because 72,400 is the max liability which can occur if any type of relief is not available. Any type of relief. Um, is the answer to this part is clear? Anything throughout the question or questions, including both, on which you are not clear or require some explanation or some sort of help? So if no more question, um, because Aisha, to have a look, gross chargeable value. So the word gross chargeable value, when I'm using, I'm like, this is after deducting available exemptions. Thanks, Aisha, for asking the question. If it's done, uh, I'm heading towards Mohammed. Aisha question is why I not deducted. Oh, answer. So answer is like the word was gross chargeable transfer, and I also use the word gross chargeable transfer. So I am like this word, the gross chargeable transfer is after deducting the available exemptions. That's why I am like this value is after deducting annual exemption. Oh, it's like self-marking. Sorry. Sorry. So uh, Any further question, any further feedback, anyone would like to ask, anyone like to discuss? I feel happy to have word or discussion. Thanks, Anas. Farhan, Aisha, Madeline, anything? Any one of you want to ask? If no, we can end up here now. Thanks. Thank you, everyone. Farhan, just FYS, you were not in the class yesterday. The recording is, sorry, not recording. The PDF is already in the shared drive. Do reconcile your answers. Uh, Anas, okay, let me ask this question to everyone. So I'm not taking name, guys, everyone. I'm not taking name. One of your fellow asked me this question. Will there be any other session? If you ask me, ideally it should be no, because from my perspective, from my opinion, now it's time for your own practice rather than you do practice with me. There can be questions, there can be queries, but there should be no more practice sessions from my side. So that is my perspective. If anyone has any different view, please do let me know. I'll happy to hear. Madeline, on your point, what your advice in terms of time management, that's a good point you raised. I do recall in the yesterday class we had some discussion like section A take a lot of time. Everyone is welcome. Aisha to connect on the WhatsApp. Obviously, uh, you guys are always welcome to connect on the WhatsApp. So Madeline, on and to everyone in terms of time management, please. In terms of time management, if section A you feels like takes a lot of time, you should start with section B. So we should start with section A. We should start with section B. Probably in your era in which you guys are living, it doesn't have as such impact because when in my era when I used to appear for exams, let's say 10 years back, when the papers were on hard copy, whether you are putting or starting from question one first, question two first, question three first, examiner knows about it from which question you are starting. But now it doesn't really matter from where you started, except time is recorded on which question you are spending how much time. That's a different topic. But examiner would not be aware like which question you attempted first, which question you attempted second, which question you attempted towards last. So you have to make your own strategy, and strategy can be best built up with the help of practice, the questions on the spreadsheet. Mm, I hope I answered your point, Madeline, and everyone. That's a good question raised by her. Okay. Um, any further question? If no, time to say bye. And thanks to everyone for joining. Uh, Thank you very much, guys. Take care. Best of luck for the exams.